then. It's 10:01 on the West Coast. It is 1:01 on the East Coast, and all sorts of different times all over the place. I know we've got Michael, Charles, and Steve. Guys, thank you so much for being here and joining us. We've got a great lineup of stuff to talk about today. We've got a number of people here online as participants, but I'm gonna start by quick introductions here. Aubrey, thank you so much as our gracious host. We appreciate you setting all this stuff and organizing this for us with these fancy new backgrounds. Check all that out. I've never used a background, so I feel like if I move too fast, it's going to wiggle on me, but that works. So Aubrey, thank you so much for setting this up and getting this going. Michael Rosen is here with us today. Michael is a longtime CFO who has a tremendous amount of experience in retail, has a tremendous amount of experience in service businesses and manufacturing, has taken several companies through the sale and transaction process, as well as starting his original career in banking. So he's really just got a phenomenal level of experience. We've got Steve Birnbaum down here, who also CFO, has a tremendous amount of experience in service businesses, some nonprofit, as well as some real estate stuff. So Steve's got some really interesting things to chat about today. And then Charles Cecil, another CFO with a tremendous amount of experience in manufacturing, works with a number of clients in the restaurant and retail side as well. So I'm really excited to get different perspectives on a whole host of things that are coming out in the world today that I think we really need to start to take a look at. And our goal today for all of you who are in the audience today is to give you a handful of takeaways that make your life better. Our mission at TGG is to make business owners' lives better through excellent financial management. And we are going to take the brain trust here that we have in Michael, Steve, and Charles and pick their brains for things that will make your life better, make you money, increase cash flow, increase the value of your business. And so today we've got to start with the most obvious of current events, things that's going on, which is interest rates. Guys, interest rates affect everybody out there. I heard last week that the 30-year mortgage hit 7.49% on average across the country. 7.5% for a 30-year mortgage, where, again, a year and a half ago, we were talking about like 2.8%, 3.1%. Good Lord, that's got to change things. Michael, I'm going to ask you quickly, with your bank background here and bank financing for your clients, what are you expecting? What are you seeing in terms of line of credit renewals, in terms of equipment financing, and what sort of advice would you give to people on this?
Thanks, Matt. So first of all, I think you touched on rates, and I would just say, we heard Jerome Powell talk the other day about that rates could stay where they are for the foreseeable future. So I think we need to be prepared that this is the new normal. Many of us are used to near zero rates for a long period of time, more than a decade. So this is a big change. So with prime over 8 and SOFR over 5, it's likely that any bank borrowing is going to be in excess of 10%. And so doing the analysis of whether your company cash flow can support that is really important now. It wasn't as important 2 years ago, but I think that's the first step in, if you're looking at bank financing, is to understand if your cash flow can support the level of interest that's going to be required in today's environment. And the second big thing, and Steve and Charles will get into this later, but strengthening your balance sheet is the best way to protect yourself and to facilitate lines of credit and other financing down the road. A strong balance sheet will help lenders mitigate risk and making them more inclined to do the deal, and it also will impact pricing. So I think that strengthening your balance sheet is really key. And as I said, there are ways to do that, and Charles and Steve will talk about that later.
Sure.
A couple other things. Okay, go ahead.
I just had a question, because I saw the same thing that you saw. I was watching Bloomberg the other day, and Larry Summers was on, the old Treasury Secretary, and he was saying that we should expect the 10-year yield to be at 4.75% on average for the next 10 years. That means that mortgage rates are going to stay, just home mortgage rates, because it's the easiest thing for us all to relate to, are going to be north of 6.5% for the next, on average. That's an average for the next 10 years. So a lot of people that I talk to are like, okay, well, then how do I get cash in faster? Because on your balance sheet, there's a whole, you look at your AR, for example, how do I collect faster? And I've heard a lot of people say, look, I should take a 2% discount because 2% is less than 10%. So I'll get a 2% discount if I can get paid in 10 days rather than 40 days. Is that the right thing to do, Michael? And how do you approach this with your clients?
Yeah, for sure. I mean, I just recommended to a client the other day who was cash rich, and I said, she talked to me about making sure we're paying her vendors on time. And I said, well, should we consider, anticipating payments if we get, a good discount for that? And the answer is yes, as long as the math makes sense. A 2% discount for 15 days is a steep interest rate if you annualize that. So you have to look at the math behind it, but there are many ways. I was talking to the same client about inventory, and for those of you that do budgeting or have your staff do budgeting, you got to get in there and really understand what's going on. There's so many assets and liabilities that can be utilized to generate cash. Inventory is one that speaks to me because I have been in a lot of product related businesses, and without really good, you could be arguing about pennies when there's millions in your inventory that can be converted into cash and generating cash flow and profit.
So what I hear you saying is, look at your balance sheet for finding ways to generate cash, but and frankly, use this to our advantage, because there's a lot of people who are looking for cash, and if you can get a discount for paying early, chances are at that 2% for paying 15 days earlier, like you said. Let's do the math here. So if it's 15 days, it's 2%, then it's 4% for 30 days. Which, if we multiply that, that's 48% a year is your new interest rate that you are achieving by getting a 2% discount for paying early. And conversely, I think it's the opposite, right? I mean, if you do the math the other way, if you take a 2% discount for early payment, you're in fact probably paying somewhere between a 24 and a 48% interest rate on that money. So I think the answer is, do not take discounts to get cash in early. Look to inventory, like you said, or other things.
Yeah.
Charles, we got another issue that I know you deal with a lot of your clients, which is supply chain stuff. I read in the Wall Street Journal here the last week that Chinese exports were down 27% to the US over the last 12 months. You see a lot of people moving to Vietnam, Bangladesh, Cambodia, other places for their supply chain. What are you seeing in this market? We have interest rates as one issue, but also the supply chain seemed to be geographically changing pretty dramatically. What are you seeing in this?
Yeah, that's a great question. So, with supply chain has been something that we've all taken a much different approach to over the last 3 years. There's been so many geopolitical weather issues that are coming up. So making sure you fully understand your supply chain has been a big topic of conversation. So specifically with China, you've seen the last couple of administrations, what I think the term they use is decoupling the US reliance on China. So what does this mean for business owners? Well, it means we need to start diversifying. That's why you're seeing kind of an explosion into other different countries, making sure that we're not so reliant on that. The other thing I'm seeing from a technological standpoint is, as robots and automation become a lot more popular and prevalent within manufacturing, they don't want to put those multi-million-dollar robotic systems overseas. They'd rather put those onshore here, closer to where their customers are. So so when we talk about supply chain, besides diversifying your vendors, holding vendors accountable, right? So one thing that I used to do is vendor scorecards, right? On making sure you're ranking vendors across some level of KPIs, so that when they come to you the next year for price increases, you can talk to them about, hey, this is how you've ranked across other vendors, and this is your scorecard. So that's something I've done. In addition to that, whenever you're talking about supply chain, it all has to be around forecasting. I'm a huge proponent of forecasting, not just your revenue, 10% more than last year. We're talking units. We want to understand how many units we're planning on selling based on some leading indicators. So focusing on that. Matt, I love, you kind of introduced me to a concept you came up with, the warehouse utilization. I love it, right? So you're paying rent on a full warehouse, might as well utilize it. So there could be some opportunities anytime we're talking about supply chain, making sure that we're utilizing our inventory. Are there discounts we can take to buy extra inventory than our forecasted demand is saying, and making sure we're fully utilizing our warehouse? And if we don't have enough, we're definitely seeing some pricing pressures coming on commercial real estate, and we're seeing that get a little bit cheaper. So there might be some opportunities to expand your warehouse to increase your warehouse capacity.
Yeah.
So
So what you're saying is if you've got enough warehouse capacity, because the other thing that I'm seeing around is I'm seeing in some industries, I'm seeing still having a supply chain problem where they're not getting enough inventory in. And in other industries, though, I've seen a big shift where they actually have too much inventory on hand. Target had a profit warning about 2 quarters ago where they had too much inventory on hand. So what I hear you saying is, look, take advantage of that. And if your suppliers have too much inventory on hand, again, ask for a discount to buy it early, and you can warehouse it if you've got the extra space and dramatically increase profitability. Tell me a little bit about what you're seeing though with some of these other countries. And the reason I'm asking is because historically, like if you worked with China, you have to put 50% down, and then the other 50% has to come when it gets on the boat and starts coming over. What are you seeing today, and how can we use, whether it's interest rates or cash management to our advantage?
Yeah, sure. When it comes to whenever you're dealing with any sort of foreign vendor, I've used the U.S. Programs for dealing with international vendors before, and they have some interesting financing options to allow you to kind of bridge that gap. So I've used those because they're really low cost ways for you to reduce the risk if you're looking to having to put deposits down on supply chains that don't that are getting where the lead times are getting spread out longer.
So there are some government financing options here.
Yeah.
So if our clients or people who are listening here have dealings with other foreign countries, and I think it's important that we talk about some of this government, which is an interesting pivot, Charles, because I've also heard that there are some grants out there and other government kind of programs for onshoring some manufacturing. And for actually bringing it back domestic. What have you seen on that front, and is that worth looking at?
Yeah, those are always worth looking at. Absolutely. So, it really comes down to there's some zones of opportunity as well, where the U.S. is giving some great incentives for developing land and developing businesses, especially manufacturing in some of those zones. So I highly recommend looking into that for sure.
Yeah, I've seen some stuff even on a state by state basis that there are certain states that are much more aggressive than others. I was just working on a deal in Ohio by way of example, where actually in Michigan, they kind of said, no, we're not going to give you anything. And then we went with this client to Ohio and they said, oh yeah, we would love to have you here.
Oh yeah.
and so I think it's not just federal, but could be some state to state stuff.
No, and in local too, right? So local
Sure.
economic development commissions, I've worked with them on just where they'll provide free land. You can use that free land as a deposit for the bank and then build your building around it. So there's some great opportunities there for sure that I've taken advantage of over the years.
Yeah, a lot of us, over the last 3 years, we're lucky enough to take advantage of things like the PPP and the ERTC and some of the idle loan stuff and these things. And I don't think people are quite as aware today that there are still a tremendous amount of programs. So Steve, one of the things that I read about here, I don't know how you feel about this from a political standpoint, but the I guess CBOE was saying that the budget for the Inflation Reduction Act, which I don't know how you call it an Inflation Reduction Act, but that's okay. It's got a good ring to it. The budget for the Inflation Reduction Act was actually not going to be, 346 billion, because it's actually going to be, they said 1.4 trillion. Which means there's a tremendous amount of spending being done in this Inflation Reduction Act. A lot of it is around climate change, whether you agree with that or not, it's there, and it's government funding. So as Charles was talking about government stuff, it just struck in my head, we need to talk about this Inflation Reduction Act and what can our clients or people who are listening do to take advantage of some of those funds that are coming out of the government so that they can utilize them in their businesses.
Yeah, no, thank you, Matt. Yeah, there's a tremendous amount of funding from that, and I think the program is, like you said, initially was 400 billion. Now it's going to be north of $1 trillion. I think there's just a lot of momentum and a lot of interest in trying to save the planet, whether you agree with it or not. I think there's just a lot of money flowing that way, and there's opportunity for clients to take advantage of that. There's massive tax credits associated with the Inflation Reduction Act, and businesses should strongly consider, investments in some of these technologies. There's incentives through 2025 for 30% tax credit, like I say, for solar and wind projects, municipal solid waste projects, geothermal, energy storage, microgrids, fuel cells, all kinds of stuff, biomass, all kinds of stuff. So, and the payback period with this 30% tax credit, the payback period is vastly reduced. So that's something to think about. I have a client that owns a building, and they're putting rooftop solar on the building. So they're not only going to reduce their energy costs, they're going to take advantage of the 30% tax credit associated with the IRA, the Inflation Reduction Act, in order to benefit them and reduce their carbon footprint and their tax footprint. So I think it's just something to think about. The money is available, and that's where it's being driven. The incentives are being driven to do these projects. We're doing a project at home for solar and a battery storage system, and high efficiency HVAC system, and massive tax credits.
Yeah, I think that's an interesting thing because it's not a tax deduction, right? Our normal expenses are a tax deduction. So if you're in a 40% tax bracket and you spend $1, you get 40 cents of benefit. Whereas with a tax credit, if you spend $1, you get $1 back of tax benefit.
That's right.
It's a dollar for dollar reduction in your income tax, which is a much different number. The other thing that I've seen, Steve, you mentioned this is this like, it seems like this is still a pretty good time to go buy a building. I've seen SBA rates with 5% down as low as 5.25%, 5.5%, which again, if you have to occupy 51% of the building and then you can go take advantage of some of these IRA things, you can almost own the building for free. Are you seeing that in other than like a manufacturing context, like Charles was talking about, are you seeing that with service businesses as well, and other types of businesses?
Yeah, definitely. I mean, I think there's a massive opportunity to get out from under a lease and a landlord. And, commercial real estate's strained and stretched.
Especially on the office side, right? I mean, the office side is really strained, so you could get a real deal today.
Yeah, massive deal on that from a lease perspective. But buying a building, I mean, you've got all kinds of options, property tax deductions and tax credits on shoring up the building. So, and the financing opportunities, like you say, with SBA and other programs, it's a great time to buy that.
Yeah, I think it's interesting because it's tough. At least the way I see it as a business owner, look, we run a fully hybrid, not hybrid, we run a fully remote organization. And almost everyone that I speak to when I go out and speak at my talks, I ask people, how many of you have some kind of hybrid workforce? It's not fully remote, but some hybrid, and almost everybody has some. And I say 5 years ago, how many of you had some hybrid workforce? And the numbers are just vastly different. So, Michael, how do you go about estimating, what your space needs are? Let's say you're a service business that's like 3 days in the office. How do you go about figuring out whether this building is worth buying, or you go fully remote, or you go hybrid? I mean, if you're manufacturing, clearly you need space, right? Or if you're warehousing, you need space. But if you're a service business, or going part hybrid, how do you sort this out with some of this stuff that Steve's talking about with the IRA? Because those are free dollars sitting there for you. Yeah. And yet you don't want to go spend money just because there's dollars sitting there. You got to actually have a business reason. How do you sort this out?
Yeah, it's very challenging. I was CFO for a large marketing company, and when the pandemic, when the stay-at-home orders ended, and we did a whole survey with employees, how to set up the office for the comeback, and it turns out a lot of people say one thing and really do another thing. And in my experience, I think that it's still, especially if you're in a service organization where people are talking on the phone, like there's a lot of sales and those types of functions, it's tough to have everyone in an office. And so when we set up bullpens for people to come back in, people just opted not to come back. So I think depending on what the functions are that you're supporting could help indicate, how to set that up. But I think it's challenging. I think that a lot of people enjoy spending time at home. And as long as you can still hold them accountable and still be efficient and achieve your company goals, then that's a competitive advantage to allow that type of scenario.
It is if it can cut costs for sure. And I think that's the balance, because we've got all these IRA things that a lot of the Inflation Reduction Act stuff is really around helping business owners, building owners, and homeowners. Steve, you mentioned that a little bit. I also, by the way, cannot figure out where we are in the economic cycle. I really have, like, it's very much impossible to me to see how our GDP is growing faster than I would have ever imagined. We haven't seen unemployment really tick up. Chairman Powell is still saying he's going to probably raise another quarter point. I'm just going to poll you guys real quickly. How many of you think we're in a recession and we don't know it? Anybody think we're in a recession and we don't know it? Obviously we're not in a technical recession, because that means GDP negative for 2 quarters. Okay, nobody. How many of you think we're potentially going to go into recession in the next 2 years? Nobody. Okay.
I don't see it happening. I think, the Fed, Powell's trying to put the brakes on the economy, and he just can't do it, right? I mean, this economy is too strong. I mean, we're at full employment. I mean, I just think I don't see it happening.
Okay. How many of you think we're going to have, here's another one. This is an interesting one. How many of you think we're going to have a recession in the next 10 years? Okay. Well, statistically
speaking, yeah, I'm going with statistics on that one. Yeah.
Okay. And so I've reread this really great book, Great by Choice, by Jim Collins. I don't know if you guys have read this, but I reread it. And one of the things that I thought was really interesting was he talks about bulletproofing a business based on random events. And there's a whole bunch of books, Black Swan, a whole bunch of books that talk about these random events. And essentially what Michael, what this book, Jim Collins is advocating is, in any business, you have to bulletproof it against some unknown event, right? We're about to come up on the what is this, the 22nd anniversary of 9/11. I don't think anybody could have predicted that. There are volcanoes that will go off, and earthquakes and fires and floods, and I mean, we're about to have a massive hurricane hit Florida in the next couple of days. Who knows what damage that's going to do. And I think what he said, and it's really interesting, is he thinks that you have to bulletproof the business against unknown events and really strengthen your balance sheet, which means constantly be looking at this. So Steve, let me ask you, what are, I don't know, by the way, I just don't know what's going on with the economy. I can't predict that stuff. I don't know that anybody can, but what do you think is really going on, and what should people do with their balance sheets, given this new volatility of interest rates, volatility of the stuff that we talked about with Charles, of offshoring and all the other stuff? What do we need to do here?
Well, I mean, a couple things come to mind. I mean, you want to try to manage cash, right? I mean, the best you can, which means like trying to lower your day sales outstanding, right? Try to get cash back.
Just for everybody else, what does day sales outstanding mean?
Yeah, it's the amount of time it takes for you to collect from your sales, right?
After
so it's a measure of how long it takes for you to get cash from the sale you've made. So a DSO of, say, 45 days is a measure, but if it takes 45 days for you to collect from that sale. But if you want to try to reduce it, down to 30 days ideally, and you want your days payable outstanding to be greater than your days sales outstanding. So you want to be paying things slower and collecting faster, essentially. So that's kind of from a balance sheet perspective, one of the metrics we look at.
Sure, I think that's really interesting. I don't think people fully appreciate either how much a little move can make. So I was meeting this morning with a business in the trucking industry, and they had $27 million of accounts receivable outstanding, and they were collecting in, it just happens to be 26.9 days. And it was amazing to see that every 2.2 days is $2.5 million of cash. And they looked at it and said, "Oh no, we're doing pretty good." And I said, "Well, could you do 2 days faster?" And they, absolutely. "Could you do 4 days faster?" Absolutely. Yeah. "Would you like an extra $5 million?" Because I think the cash management component has never been more important than it is today. The other corollary to rising interest rates is rising interest rates you can take advantage of. So, Charles, what kind of rates are you seeing, and what are you doing with cash management to figure out how much cash people should leave on a balance sheet to pay payroll, to do kind of in the checking account, versus how much cash should be sitting in, being managed in either like a 5% money market account or 5.5%, 3 month, 6 month treasury bills? What are you doing?
Yeah, it's a interesting thing that a lot of companies are now asking themselves before, because the term sweep account kind of went into the encyclopedia and back into the counter, right? I mean, the idea of a sweep account is now coming back And it's an interesting thing. But, before I get in there, I want to add something to, don't just focus on days sales outstanding. Think about your vendors too. I was having breakfast with a private equity firm, and he was telling me, hey, with all my portfolio companies, we're paying our vendors once a month. And we're trying to extend out our terms that we're taking with our vendors by having one payroll cycle or one payable cycle a month. And so it's just a way that everyone's trying to extend that cash, because when you extend cash with vendors, it's interest free. And that's the same way your customers are seeing you. So
well, I think that's fascinating, Charles, because let's walk through the math on this. Let's assume that you look at your balance sheet, you're a business owner, you're sitting on this thing, and you go, I'm going to go check a look at my balance sheet. And you look at your AP, your accounts payable, and it's $500,000. And you're paying, let's just say, every 15 days. You can increase your cash by $500,000 by paying, your AP will go to $1 million, and your cash will go up $500,000 by paying once a month versus twice a month.
Right.
It's a very simple thing, but that could make another 5%, that could make another $25,000 a year that is lost right now in terms of profits, and instead being given to your vendors.
Right.
So that's an interesting concept.
Yep.
Cool. Well, talk to me a little bit about, so that was good. Talk to me a little bit about how you're figuring out how to manage cash though.
Yeah, absolutely. So when it comes to cash management, there's so many factors, and every business is going to have to look at this differently, because there's an element of how much AR we need, how much, how big is our payroll. So for me, I tend to think of it, especially if we're a service business, in terms of how many payrolls do we want to have in more liquid cash versus how much do we have in the interest-bearing money market accounts. So other times when it's more traditional manufacturing, I'm looking at operating expenses. So, 1 month of operating expenses to 3 months, just kind of, again, depending on what you're looking for. Now, this all comes back, I'm going to take almost every answer back to forecasting. A lot of it has to do, what sort of big things do you have in the future that you need to have cash on hand for? And if the next 3 months are looking like, the last 3 months, then, come up with a good number and then hold to it. And then what you can do, we set this up for a client recently where we set up a sweep account so that vendors are paying into an account, or we're paying out vendors from one account. That balance in that bank account stays at zero. When the vendors present the check, the bank moves cash over to fund that check. Same thing with on payroll. So
that's really maximizing interest if the balance is effectively zero and then it's just swept every minute. That's pretty fantastic.
Yep, and we're coming from a 5% account right now. So the bulk of our money is sitting in a 5% account, and it sweeps into so the accounts are the cash accounts that are not interest bearing are the ones that we're writing checks from, and those are being swept into
and they're effectively zero, right? I mean,
always zero. Yep.
Steve, are you seeing that same? That's pretty fantastic. I actually hadn't heard of that.
Yeah, no, I think it's just-in-time cash, right? Just having the cash come in when it's needed at the time it's needed. Otherwise, it's parked and earning interest, in some form, right? In 5%. But one of the things I wanted to mention about a potential way to use a balance sheet is I had a client where I advised them to buy excess inventory in a rising cost environment. They had excess warehouse space, so they had space in their manufacturing facility to buy the inventory, and they had sufficient demand for their products. But this strategy yielded two benefits. They're buying inventory at a cheaper cost, so they're paying less cash than if they had waited. And then when that inventory flows through cost of goods sold, it's at a lower cost, so it improves their margin. So it was a double hit, double benefit. Lower cash for buying the inventory, and then higher profitability when that inventory flowed through COGS for sales. So, that was one example where it was a great hedge against rising costs. If you've got demand and you've got warehouse space, it's another way to leverage a balance sheet to try to generate cash. So I wanted to throw that example out there.
Yeah, what I'm hearing you say is very similar to what Michael said earlier, which is, look, if you can use your cash and a strong balance sheet to get discounts and take them, you're going to increase profitability. Otherwise, what you really want to do is collect faster and pay slower so that you maximize profitability on the interest side. So it's
Right.
either I got to get a discount for paying early, I got a discount for buying in bulk, or I have to pay slower and get paid faster. And the other side of that inventory, Steve, is inventory turns. What are you seeing going on in the marketplace with inventory turns, which is, just to define it for everybody, it's taking the inventory you have and how quickly you can move it through the system. And I always tell this story because it's a really important one. You know, when Steve Jobs was running Apple, he brought on this really interesting guy, Tim Cook. We've all heard of now, okay, but very few people had heard of Tim Cook at the time. And it just turned out that he was like this amazing logistics guy. And at the time, when they did this, the iPhone was turning over, and the entire inventory at Apple was turning over every 17 days, which was pretty good, except Motorola was turning over their flip phone inventory, which was the hottest phone at the time, every 14 days. And Tim Cook said, we can do a lot better than this. And today, Apple turns its inventory over every 4 days, which what that means is, and practically what it meant is they crushed Motorola because they needed 1/3 of the amount of inventory space, warehousing space. They didn't pay for warehousing space, and instead they paid for marketing that made people think different, so that we all have an iPhone and we all think different now. But I say that, I tell that story because it's amazing. Inventory turns, like they turn into they not only free up cash, they free up profitability, don't they, in terms of warehousing space. So Steve, what are you seeing if we buy in bulk and now we're using warehouse, then we're getting we're increasing profit. But how should people approach their inventory turns? What's the real, right way to look at dead inventory versus productive inventory? How do you look at it?
Well, I mean, I think that you want a sufficient amount of inventory, but not in excess. So there's a balance there, right? So you don't want to, you want to really look closely at the demand from your customers. Look at, like, back to Charles and the forecasting, look at your forecasts and see if you've got the demand to move that inventory. You don't want to just sit on it. But in a rising cost environment, if you can get it, and I know the supply chain constraints, if you can get it now and keep it and hold it, as long as you've got that demand. So I'm seeing kind of inventory turns sort of go up for some businesses, sort of trending up, but not in a dangerous level. I think businesses are being very strategic about the inventory purchases they're making, and not overdoing it, not driving that number up in terms of the
right. Yeah, I know our TGG way is to do at least do cycle count for on a $10 million business and above, is to do cycle counts once in a month and full inventory counts once a quarter. And once you get above 20 million, it's really cycle counts once a week and full inventory counts once a month. But I thought you mentioned an interesting thing here. And Charles, I'd love to get your opinion on this, which is hedging strategies. You said rising cost environment, Steve. But I think what we're seeing in things like copper and lumber, in concrete and all of these things, we're seeing like prices bounce around like a bouncy ball. And I'm not sure I can tell what it is, but it feels like, and what I've seen a couple of clients do is start to use financial hedges to be able to deliver kind of more consistent pricing for their customers, and also, frankly, lock in some profitability for themselves. Charles, what are you seeing out there?
Yeah, there's definitely two ways to do it. I've used both. So you can pay for it, or there's ones that you don't have to directly pay for. So I think what you've alluded to is more of the financial instruments, derivatives. These are great options for people to use in order to have that profit. What I run into with clients when I'm talking to them about hedging, they're like, well, sometimes I make a lot of money because my price stays here and then it dips and I make all this money, right? So sometimes you have to have that conversation about, well, sometimes it goes up, right? And you lose your margin, and they remember those times too. So it is a discussion. But you have to, whenever you do that, you have to make sure you understand the full cost of that financial instrument, because it does cost money. You need to build that into your pricing structure of your products, and so make sure that you are pricing in those the cost of the financial instruments. Now, when you talk about maybe the non-financial piece, these are more of your longer term purchase orders, where you tell a vendor, hey, here's how much I'm going to buy from you for the next 12 months. and then maybe receive delivery from it. If from a steel background, we'd use service centers, so they'd hold our inventory. We'd make big mill buys. They'll hold the inventory for us and then release it to us as we need it, because we didn't have the space for the whole mill buy. So that's an option. But in any way you look at it, one thing I've noticed in order to hedge more than anything is change your customers' habits around a annual price increase, right? Those days are kind of gone. What we need to do is look at targeted price increases by product, by customer, so that we're evaluating prices more often and sending out price changes to customers more frequently than having them just expect the 3% in January every year.
Yeah, the bottom line is we're in a much more volatile environment, I think, which also then gives more value if you can actually hedge and somehow keep your prices constant. You're probably in a competitive advantage relative to other folks. So, Michael, what are you seeing in this world?
Yeah, my experience is on the other end of the spectrum. It's more in consumer products, which have a very limited shelf life. And I think in those situations and for those companies, inventory is typically the biggest asset, and it's the biggest area for potential risk. It's funny. It's not, when it's cash, it's easy to see. When it's accounts receivable, it's easier to see. When it's inventory, it's easy to miss. You just have a lot of SKUs and a lot of quantities, and you don't realize how much of a loss there could be in there. That and everyone learns this, the first day in school, in business school or wherever, but inventory never gets better over time. So if you have an offer to sell old inventory, you just got to liquidate this stuff. You got to not fall in love with your inventory. You got to take your losses and move on. You got to factor that into your budgets. But I see so many companies get in trouble with their inventory that they sit on it too long. They think it's going to turn. They think they're going to, and it just always turns into a bigger problem. So you got to be vigilant about that.
Well, I think that's a really important point here, and that is that there is stuff we in TGG we call it dead inventory, and dead inventory is defined as inventory that you're probably not going to sell, but it's still on your books. How do you make sure you're not getting fooled, Michael, with your total inventory number that could be 20% dead inventory that's just sitting there, that's like you say, not getting better with age? It's not like fine wine.
There needs to be someone that in the company you hold accountable to that. And it could be a purchasing manager, it could be an inventory manager, but someone needs to be looking at the SKU level on a periodic basis and looking at the inventory turn and making decisions quickly. If you have a direct to consumer business, you got to be looking at that much more quickly. Like you should be looking at every 4 to 6 weeks, the sell-throughs, and making decisions on markdowns, because especially in that kind of a business, every day you lose is a day you lost. You can't make that up. So if you wait and you have all this inventory at the end, you lost the opportunity to sell it. So you got to react quickly. And you, like I said, you got to be vigilant about it. You have to make someone accountable, and you got to act.
Yeah, I think that's really interesting. Inventory management is one of those, like you say, kind of hidden things, but it can really drive a lot of profitability if we're doing it the right way.
Yes.
Both in terms of saving cash, being able to get interest on it, and or like Steve was talking about, buying in bulk and getting a discount, or as Charles was saying, like using either contractual hedging strategies or financial hedging strategies. Charles, if I understood you right, to keep prices level, which then can increase your volume of sales because you can do stuff that your customers can't, or your competitors, can't do. All right, let's move over here a little bit to some other stuff, because I think we're in a weird time with interest rates. I just saw a line of credit renewal at 11.5%. I thought I'd seen the highest one because I saw one at 9.5% about 3 weeks ago, and I just sort of won at 11.5%. So, Michael, at what point does it make sense to start thinking about taking on equity and partners in these kinds of things? And Steve, I'm going to ask you the same question, because I don't think there's a right answer here. I really don't. I think there's a financial answer for sure. And so I'd love, Michael, if you can share kind of the financial answer and then your opinion about it. And then Steve, I'd love to hear your opinion about it as well.
Yeah, clearly there's a financial answer, and it has to do with some analysis as to what your multiples are in your particular industry for taking on partners, and what the cost of the debt is. But I think there are other considerations too. I've worked with a number of private equity firms over the years, and there are some instances where taking on a private equity partner or some other kind of partner brings other advantages that debt doesn't bring. So I think that's an important piece to the puzzle. They help build that infrastructure. They have knowledge of how to do that. Oftentimes they can help open doors for additional revenue. They have a lot of times these firms specialize in industries. So when you partner with them, they bring along experience and knowledge that they have. So those are some other considerations that I have seen work significantly in those partnerships above and beyond the financial consideration.
Yeah, it's just interesting because for years and years we were all told like debt is cheaper than equity, and it has been. I mean, when interest rates are 4%, it's a 25 times earnings multiple, right? So if your business is trading under that, it's much better to take debt. What do you think, Steve? Where should people think about if they've got to raise capital today and they're faced with an 11% line of credit renewal? What do they do? And we talked about all the other ways you can get cash out of your balance sheet. That's clearly where you want to start because that's interest free. But let's talk about kind of if you're thinking about bringing on partners, what's the pluses and minuses?
Yeah, I think to what Michael said is I agree with. I think to some extent you want to be careful about bringing on private equity because you might lose control, give up control, operational control, management control. So there might be some strategic reasons to think about doing that. I mean, like I think a private equity or a VC firm is their required rate of return is going to be maybe north of what the debt is, right? And maybe 15%, 20%. They want to flip it and turn it. So it might make sense for a few years to take the debt on if you can do it from a cash flow standpoint. You have enough working capital to manage that debt. It may be something to think about versus giving up, maybe control of the company. But like Michael said, and I agree with, they bring a lot of operational discipline and control and things that maybe that aren't embedded in the business naturally. So those are the kind of things that come to mind when I think of that debt versus equity partnership.
Yeah, it's really interesting because I think we've had such a hard we had such a tough M&A market for a long time, and then all of a sudden the M&A market went and ballooned, and from 2017 through 2022, really, we had just this massive multiples being paid for businesses, and it set every expectation that a 3 to 5 times earnings multiple was terrible for small businesses. And now I'm seeing multiples falling again back down. So Charles, how do you separate yourself in this environment? If you're thinking you're going to sell in the next couple of years and multiples have come down, how do you still kind of get into that top echelon of where multiples were a few years ago?
Sure. Yeah. So, you really need to have understand your end. Where do you want to go? How much do you want to sell for? And so, when I meet clients and their goal is to sell in 3 to 5 years, we really need to walk that back, because when you go through and you want to cash the check in 5 years, you're going to have to go through 6 months and 12 months of due diligence and going out and around, going and finding, the potential investors or the company that will buy you. From there, as soon as you start due diligence, they're going to look at the previous 3 years. So you need to make sure that you have the financial performance you want to have your money valued on in the 3 years leading up to that. So that leads us back to this year. What are we going to do this year in the next 12 months that we can start reaping the benefits over the next 3 years so that we are in the best position 5 years from now to get paid the highest possible multiple? There is a piece of it that, we don't know what it's going to be like in the future, but there is some basic blocking and tackling that companies can do that are tried and true ways of making sure that they can get the highest multiple they can in the environment that they're trying to sell in.
Yeah. So what do you think? Sorry, go ahead, Michael.
Well, I was just going to add a couple things to that because I think there are a couple things that I've learned that are really key. First of all, is keep everything clean. The fewer questions and distractions. So things that cause distractions are when you don't have contracts, when you don't have leases, when you're accounting, you don't have good month-end controls, you're not doing financials consistently, you don't have documented internal processes, maybe you have excessive journal entries, or you have accounting changes or prior period adjustments. All that is fine. It's normal, but the more stuff you have like that, the more questions there are going to be, the more time you're going to be spending in diligence answering those types of questions instead of talking about the real meat and potatoes. So I would make sure that everything is clean in that regard. But the other thing is one thing I learned is if you have a really good budgeting process and your budgets over years tend to be accurate, you have a much better argument to be paid on future earnings. And I've seen that. And so if you can really get your budgeting down, that could have a big impact here. And the last thing I would say that is truly beneficial to me is that everyone on the team is telling the same story. Because essentially what you're doing, you're telling a story to people, and obviously the financials back it up and the people back it up, but everyone's got to be telling the same story. And when that works and everyone's aligned, I think you can maximize your returns.
No, that makes sense. The telling the story in alignment where there's not like a disconnect, so that there's no mistrust, because the safer a business is, the higher the multiple is going to be. So what I want to do here is we're starting to get some chat questions in the Q&A. I really appreciate that. I want everybody, if you've got a question, please load us up here in that Q&A. So you go into the Q&A section and post a question there, and that will come to myself, and I'll be able to ask the panelists here those questions. So the first one I've got here that came through is, what are typical current EBITDA margins? Multiples. What are current typical EBITDA multiples in manufacturing? And just so that we're all on the same page, EBITDA is earnings before interest, taxes, depreciation, and amortization. Basically, what are the multiples of net income, of operating income, that you're seeing in manufacturing today? I'll start with you, Steve. What are you seeing in this world? I know you've gone through a handful of these. What are you seeing?
Well, I'm seeing multiples for manufacturing a little bit lower than some of the other industries, service industries, and some others. I'm seeing anywhere from 5 to 7 on a multiple associated with manufacturing. That's kind of what I'm seeing.
Yeah, I'm seeing the same thing, except the big kind of bugaboo is I'm seeing a lot of arguments around inventory and quote unquote working capital, right? What's a strategy that you have used? And I'll ask this of all three of you guys to get those multiples up at all, because I'm seeing that same 5 to 7. But then if you're leaving all the inventory in there and you're leaving cash in there and all the rest of it, you're leaving a lot of money on the table that you've paid taxes on potentially.
Yeah.
Steve, what strategies or how are you advising people to not necessarily change the multiple, but to get more out of the transaction?
Well, I think, it gets back to what we were talking about earlier about inventory management, and making sure that, especially for manufacturers, it's effective utilization of your lease space, your manufacturing warehouse space. It's effective management of inventory. It's looking at inventory turns. It's not, it's everything we've talked about today in terms of
trying to be in that top echelon of performers so that you're really getting the top end. Charles, what else are you seeing?
Yeah, again, this is going to come down to who your buyer is, but let's just take, for example, a financial buyer. Their goal more than anything else is just don't lose money, right? On any transaction, like they just don't lose money. So one thing I do to make sure that they have, and the way you lose money is you take on too much risk, right? So how do we lower that risk? And the risk, in your mind, when it comes to having too much inventory, is you have to be very transparent in your sales cycle. So they need to understand that you're a financial buyer. They need to understand that if I put $1 here in marketing, it's going to equal this much over here in gross margin in the future. So you need to be very transparent, have a very clear sales cycle so that you can show them, hey, these are what our leading indicators are saying, and this is why I need this inventory.
So really having a good sales funnel that has measurable
sales
funnel with measurable conversion rates that say, if we put 100 people in here, we've got 80 that are interested. We've got 40 proposals. We've got 10 that turn into a negotiation, and we have 5 clients at X revenue. That makes sense. Michael, what are you seeing in terms of any other strategies that you're seeing to maximize the multipliers here? And it's not necessarily a multiple necessarily. It could be just maximizing the value out of a sale.
Yeah, I'm going to talk about some probably obvious ones, but maybe not to everybody. But first of all, there's a kind of a ridiculous concept called adjusted EBITDA. But buyers expect there to be some amount of adjustments. Now, if you go crazy, buyers will push back, but I don't think many buyers expect there to be 0 adjustments. And what you should be thinking about, as I think Charles mentioned, when you're planning 2 years out on this, you should start flagging things that you are calling adjusted, for adjustment purposes. And I would call anything that's non-recurring or extraordinary. I would flag that as adjusted. So you can quickly run a report every month of your EBITDA and then add back your adjustments. And if you see that progression every month for 24 months, it becomes kind of more acceptable. And
Yeah.
you should push that a little bit, because as I said, there's some expectation there. But in terms of, and the other thing I would say that's sort of obvious is that, 2 years out, start looking at stuff and saying, anything I'm spending, and there's a limit to this, but basically anything I'm spending could be 6 to 12 times more if I don't spend it 2 years from now or 3 years from now. And
No, that's
the easy things to look at there are travel, using recruiters. By the way, some of this stuff I had also put in a flag for EBITDA adjustments, but in any event, that's another way you can build EBITDA. The other thing I would just say when it comes to multiples, anything that contains the word like tech enabled, or there are certain like triggers that buyers are excited about. And so if you can fit your business model into that bubble, it just will generate even a couple of points higher, and that could be significant.
Yeah, one of the things I'm thinking about, Michael, that you just mentioned is how do you take a non-recurring revenue business and make it look like a recurring revenue business?
Yeah.
Charles mentioned the sales funnel. I like to advocate for something I call a retention funnel, which is how do we retain clients and get repeat business in the same way. I think there's two other ones that I would add here that I think are important. One is your use of working capital. Working capital is not an accounting definition. And everybody asks me, well, what is working capital? Working capital is a made-up term. Okay. And so everybody uses it, but it's always negotiable. And so what I tell people is as you get closer to a sale, you really want to take most of the cash out of your business. You want to trim inventory to where it's as low as you need it. Now, if you have to loan money back into the business, that's fine, but you want to take that cash out. You want to keep AR as small as possible, because otherwise buyers tend to want to keep that stuff. And they say, well, you've had this working capital in the business for the last 12 months, so you must need it. You must need to keep it. So we want to think about cash management as we get close to this. But again, I think answering the attendee's question, current multiples, I think Steve is right, are somewhere in the 5 to 7 range. I've seen them stretched up into the 10s still, but that's kind of like yesterday's news. I mean, with interest rates, when private equity funds could borrow at 4%, they could pay those kind of multiples. Now they're borrowing at 8, 10%. They can't pay those same multiples. And it's just changed. So we have to do more to generate top quality performance to get those top end of the multiples. I got another question here that I want to throw at you guys. And we have about 5 minutes left here. So what I want to do in those 5 minutes also is I want to get from each of you your number one kind of non-obvious way that a business owner can make money, or different strategy, unique thing that they could do, something that about that they could come back to us and say, hey, listen, how do we make money doing that? That's an interesting idea. So I'm going to put that out there. One of the questions we just got, though, is do you think the banking crisis is over? Meaning, do you think other banks are vulnerable? How should companies be protecting their operating cash? I saw an interesting article in the Wall Street Journal that said the mid-market banks are really struggling. What is your opinion on this, Steve?
Yeah, I think there is some volatility in the banking industry still, and I think I would advise clients to go with the tried and true commercial banks. I've got someone at my door, so my dog may start barking in a second. But I would advise to park the money in some of the Chases and the Wells Fargos and the other Merrill Lynch's and the Schwab's and those kinds of things to stave off potential volatility. Still think there's volatility in the banking industry for some of the smaller mid-market banks.
It's interesting. I had my accounts at First Republic, and now I have them at Chase.
Yeah, mine have been with
but
Chase.
that's because Chase, JP Morgan Chase bought First Republic. The nice thing is, I don't think we have to worry about deposits. No depositor has lost money since 1929. So I think we're good there. But I do think that there's a lot of shakeup in terms of what services you can get and what you can't get, and I think banks are going to have a real hard time. I saw an article that said $1.4 trillion of commercial debt on buildings, on office spaces coming due in the next 12 months. So we're not out of the woods. I think you're right, Steve. I don't think we're out of the woods on the banking stuff. All right, let's talk another one. I'm gonna focus this one to Charles. Charles mentioned a decreased reliance on China and more manufacturing companies like Vietnam, Cambodia. Do you see countries like Mexico or others emerging in its place? If so, which ones do you see that are going to win that are closer to the U.S. border?
Yeah, Tijuana has always been a big one right there near you guys in San Diego. So, that one, there's a lot of interesting 3PL activity going on in Tijuana right now. Mexicali has always been good. I'm in Texas here, so Juarez and those have always been good and are continuing to grow recently.
Yeah, I'm seeing an unbelievable demand being in San Diego for the maquiladoras, and even more than the maquiladoras, the fast tracking on getting the shipping across the border. And so definitely something to look into. I think Mexico is really a huge beneficiary of China and this sort of China-US boxing match that's going on. All right, Michael, this is a political question. It's not necessarily a political question, but it came, so we're gonna try to answer it. Does your opinion on a near-term future recession change based on who the next president is? And it's an interesting topic because I read that there's a bunch of Democratic hopefuls that are kind of crossing their fingers that Biden will retire. And I think there's a bunch of Republican hopefuls that hope that Trump will go to prison. So I don't know. I don't know which one works, but does a recession change? Does your opinion on a recession change based on who the next president might be?
Well, I'll start with the easy answer. And given that my opinion was that it's likely that there will be one in the next 10 years based on statistics, I'll stick with that. But that has nothing to do with politics. But I don't know that it does. I was reading some stuff the other day from the Wall Street Journal about how the bigger risk for me is the international relationships and the international markets and how all that interplays, because there's a lot going on there and there's a lot of thoughts there as to what various countries will think. And of course it's polarizing there too, because there's some countries that like it, some countries that don't like it. So I think there are other issues that economic issues that will arise. I'm not sure recession, in my opinion, will change based on that.
I don't see a recession risk changing with the presidency. I see a recession risk changing with policy decisions. I mean, I don't know if you guys saw yesterday, China Evergrande, which is the big Chinese developer, their stock was down 78% yesterday. They're probably done, I would guess. All right, let's go. We got hot seat here. 3 minutes left. I want your number one idea here for a generic idea for people to make money. Michael, you're first here. What's the number one idea? And it can be, it could be something tried and true, or it could be something on the fringe. You tell me.
Well, I would say two things. I would say number one, employ these tactics of monetizing your balance sheet and doing stuff with your cash that generates income. And we talked about the various ways you can do that. The other thing I would challenge, again, in my business, like consumer products, I would challenge, looking at other channels of distribution. I'm working with a client on who's never been in Amazon to looking at Amazon, and that could really open up things. So I think that's an area that could bring opportunity.
Super. I love it. Steve, how about you?
I would say, I guarantee you in any business, there's leakage on the P&L. We've been focusing on the balance sheet. It's like, when's the last time you looked at your pricing policies for revenue? When there's costs coming out of COGS, even a 1% drop in COGS or OPEX can increase your net operating income tremendously. So there's always leakage in every business, and TGG is experts in finding that stuff. I'm doing it for clients, all my clients, and doing this deep dive on OPEX and COGS and trying to reduce it even just by a fraction helps tremendously.
I love it. Charles, last but not least.
Yeah, build a culture of innovation. There's a lot of there's a lot of risks out there. Employees are very in tune with what needs to happen. Work through a way to get ideas from employees, prioritize them, and take them through the process of innovation. Reward employees for coming up with great ideas. I love helping clients with the stage gate process. So
I love it. I love it. All right, guys, thank you so much. Aubrey, thank you as always for putting this on. Michael, Charles, Steve, everyone else who has been a part of this to make this happen. Robert Rodriguez, internally, everyone, you guys bring the brain trust and bring the value to our clients. Help us fulfill on our mission to make our clients' lives better through excellent financial management. If any of you out there in the universe need help with any of this stuff, you've got 3 experts here to go to, and the rest of our team at TGG is happy to help. Thank you all for joining us. We start on time and end on time. It is 11 on the Pacific Coast, 2 on the East Coast. We will see you all later. Bye-bye.
Thank you, Matt.
Thanks, everybody.
Bye.